Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Well, we just wrapped up our conversation with Stephen Sinko, Fifth Bridge Funding on hard money lending. And man, I really enjoyed that conversation. How about you?
I did too. It was different. I mean, it was unique perspective on money. And a couple of things that I found was interesting was, for one, when you're listening to this, there's probably a lot of people who invest in real estate or people who are looking for hard money. And this is an option. And there's some things to learn on how to evaluate the deal. But also, this is also the ability, if somebody has some cash and they want to become the banker, and then maybe they want to become a hard money lender, there's some nuggets in here where you could learn about putting up your money to become a hard money lender. And probably the most interesting thing, that I think we talked about here was the difference between like rates and volume. And we didn't go to too much detail in the actual podcast, but one thing, with a hard money loan, the interest rate is going to be higher than a commercial bank. And a lot of times that rate is going to scare people away. But we need to look at the big picture. We need to not focus on rates. We need to focus on dollars. So when you're doing, it's one thing if you have a 30-year loan at 12%, but it's something different if you have a 6-month loan at 12%. So what I would encourage you to do is don't focus on the rates, but just focus on the expense, on the dollars. How much in dollars is this loan going to cost you? And then incorporate that in your deal. If the numbers work, do it. If they don't, then don't do it. But just focus on the dollars and not the rate.
Great points, Anthony. You done? Finished?
Yeah. I was going to, any highlights that you had?
Thanks for tossing it this way. Absolutely. My highlights, I thought Stephen did a really good job of giving us a general introduction to hard money lending. He defined a lot of the terms and kind of how that business operates. And then also what he did is he really dispelled two really big misconceptions that I think are associated with hard money lending. When people come in and we typically have this conversation, there's a couple misconceptions that pop up, and Steve addressed those and did a really good job as far as dispelling those. So I enjoyed that part of it.
Perfect.
Yeah, look forward to it. Hope you guys enjoy it. All right, welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host, Anthony Faso. Anthony, how are you today?
I'm doing good. I want to welcome Steve Sinko to our podcast. I'm excited to learn a little bit more about hard money lending.
As am I. Steve, welcome.
Thank you. Thank you very much. Glad to be here, guys.
Yeah, Steve's with Fifth Bridge Funding. There you are, a licensed Nevada private money mortgage broker. And let's dive right into it. Steve, can you tell us what hard money lending is?
So it is, in my mind, it is the fifth method of loaning money, or at least putting money out into the market. There's cash purchase buyers. Okay. There's going to be equity partnerships. There's going to be bank financing or conventional financing. And then finally, it's private money lending or hard money lending.
Okay. So what is hard money? How is it different from the other four?
Most would say it's fast. We get an application, we can fund that application or at least fund that project within 5 to 7 days.
Okay.
The credit criteria is a lot lower. We're not really looking at credit scores. We're not pulling credit. We are more concerned about equity in a project, equity in a property, money as a down payment. So after we look at that, after we've looked at the property, after we've had an interview with the borrower and received an application, we move forward, and we move forward fast. So usually applications that are coming to us are applications that have either been out there for a while. There's a partnership that's fading, falling apart. So one partner is buying out another partner, or a lender has committed to a loan and all of a sudden is unable to fund in a certain amount of time frame. So a buyer's earnest money deposit might be lost. A project might fall apart if a hard money lender doesn't come in and save the deal.
Okay, so they're having difficulty getting traditional financing.
Yes.
Right.
That is one of the ways.
Okay. And now, so could you expand on what are some of the reasons? I know you just touched on them, but I'm sure that there's more. what are some reasons why somebody couldn't do traditional financing and would need to look into hard money lending?
So traditional financing, you have underwriting guidelines. Those guidelines
Set by who?
Those are going to be set by whoever that lender or that major lender is that is backing that loan officer.
Okay.
So that loan officer has received an application and says, okay, let's get an appraisal. That underwriter saying we have certain criteria in that appraisal that has to be met. That might fail, but not discovered for 20 days. We have inspection reports. So that underwriter might look at that inspection report and say, hey, guess what? There was mold that we didn't know about, or there is a flaw in the foundation and we don't want to be a part of this project anymore. And they back out. Some borrowers do things with their credit right at the last minute where they go out and buy a car. And then that underwriter has pulled another credit score and realized that there is a debt to income ratio problem. I'm trying to think. I did a deal last week where it was Sunday night. I was just sitting on my couch and I get, members of certain groups on Facebook. And this guy's like, lender just pulled the carpet right out from under my feet. Who can close a $220,000 deal in 4 days?
In 4 days?
4 days. And I'm like, give me a call. Just joking, right?
Yeah.
Well, at 3:30 in the morning, a full package got sent to me. I wasn't up at 3:30 to see that, but a full package came in and I was like, I don't need that. I don't need that. I don't need this. I don't need that. What I need is to proof of funds. I need to know that you have the money for the down payment. I said, I need you to fill out my application and I need the preliminary title report. I made 2 calls to 2 investors. We funded that deal in 4 days.
Wow.
Otherwise they would have lost the whole thing.
Wow. That is impressive. Oftentimes I hear how everything is going smooth on the deal, and then it always seems like with 3 days left, or sometimes even 2 days or 1 day left, the underwriter needs mysteriously this extra form that they didn't ask for 60 days ago, but they need right now.
Yep. Yeah, and I mean it's stressful. It's stressful on all parties. The loan officer thought everything was fine. They were just waiting for loan docs to come in, and there's just always that little, where are the loan docs? When are the loan docs coming in? And it's, the underwriter or someone else in that department's like, oh yeah, that's already moved on to the next place. That's already on to the next place. And, at the end of the day, I control, this is my house, my business, but I know where everything is at all times, so if I'm saying I'm generating loan docs, they're done in like an hour or 2. I send them to the title company. I'm communicating with my investors, doing that right now, actually. We're funding a deal right now. And I'm communicating with my investors. My investors are wiring money, and we're ready to go. We're closing.
Is that typically a typical scenario for you? So something falls out, and then they kind of reach out to you? Or where are people normally coming to you, and what part of the business cycle, I guess?
If I had to guess, it's about 20 to 30% of my business.
Okay.
I mean, I love an application that comes in with a contract that says we're closing in 20 days.
Yeah.
And I can tell that borrower, look, I understand that you might want to shop. I know that I'm not the cheapest one in town. We'll talk about rate and price in a second. But, I am also locking my investors in. I'm making sure that money is set aside. I'm preparing loan documents. So I would appreciate it if you commit to me and I commit to you. That could be about 30% of my business. And then, I would say 50% of my business is refinance. So refinance is, I've got a vacant land piece that I've owned for 4 years. We're trying to pull a little equity out of it. It's going to be a first deal. Can you go take a look at it? And I'm like, I've got a couple other things that are more pressing. Can you give me 5 days? Can you give me 10 days? And we have a little bit more control over refinance because there's no pressure. There's no escrow that has to close earnest money that will be lost.
Yeah.
Drying out.
Yeah.
Okay. Yeah. No. So, before we go more into the mechanics of hard money lending, why don't you give us a little background about yourself and your firm?
Well, so let's go back. I came out here in 1992.
Here is Las Vegas.
Las Vegas, Nevada, to go to hotel college, just fresh out of the Army, basic training, AIT.
Cool.
Las Vegas was like one of 4 choices. There was a friend that was already here going to school, and she was like, this is the best place to go to school. At that point, I was like, you know what, hospitality is the way. I want to go into the hotel restaurant program. It was a fantastic program. I graduated in 1995. I was in the fraternity, teak, made a lot of great friends, and immediately went into the industry. I started working with Guy Fieri.
Okay.
We were running restaurants out in LA, but I left a girlfriend back here, and LA is a really big town for a little guy. I'm from a very small town. So we ended up getting back together and getting married, and I moved back to Vegas and started running restaurants here, and then started having kids. And the restaurant life and those hours, working late at night, and you're all amped up after working that shift, so you stay out a little later, and then your kid's up at 6:30 in the morning, and my wife was like, you can't keep doing this. So I was like, all right, how do I find a job in the financial institutions, or at least something with weekends off? And I was 9 to 5, and Norwest Financial hired me. It was a credit-based lending company. They were doing 90 days, same as cash. We were doing auto loans. We did a few real estate loans. So progressed all the way up to branch manager, and Y2K was coming.
Oh yeah.
And so we had geared all up for that. But my father-in-law was operating and owning a hard money, private money company. And he had seen my career path and what I had done. And, he wasn't getting any younger. So he said to me, he goes, do you want to learn my business? And I was like, absolutely. This is what I want to do. I want to be my own entrepreneur. I want to run my own business. I would love to take over your company someday. So I learned from a guy that had been in the business over 30 years. I learned how to type loan documents by hand. I mean, it was full-on customer service. You drove to the title companies. You hand-delivered your loan documents. It was, the basics.
Yeah.
So we worked together for 5 years. And then, unfortunately, my marriage did not work out. And when that didn't work out, the job didn't work out.
The business didn't work out either, yeah.
So, but I had a chance to move from we were like a $12 to $15 million company. And I moved to a $165 million company. I became executive vice president for a company called Clayton Mortgage. During this whole time, I was the president for the private lenders group for the state of Nevada. So what we did was we tried to create a uniform voice. And, I had companies like Aspen and Vestin and Del Mar and Diamond Bay and Builders Capital. They were all members of my group. And we would go up to Carson City and we would lobby. We would hire lobbyists to go in and represent our interests in 645B, which is what we're regulated under.
Okay.
Great experience. And then 2008 hit. So 2008 hit. Clayton Mortgage was one of the biggest lenders to companies like Focus Property Group. That's Ritter's Corporation. So Mountain's Edge, Inspirata, Kyle Canyon. We had a deal that was going on out in Pahrump. So these were all borrowers that we learned to work with, and kind of unfortunately had to go down that road of foreclosure. So 2008 to 2010, 2011 was just workout time, where everyone was just trying to figure out a way to survive and figure out what we had to foreclose on, how we had to manage it. Am I giving you too much?
No, it's good stuff.
Great background.
So 2010, I was a part owner of a mortgage company, really liked being a part owner, but, also wanted to learn more about the title company industry. So I started working for a small title company that was new to town. They were called Netco Title Company. They're still in town. I was their marketing rep. So I was meeting realtors that were working on short sales, which was a huge business back then. Small developers, just anyone that was just still trying to survive in real estate. And so I also had a method behind my madness, which was I needed a paycheck. And by having a paycheck, I could qualify to buy a house again someday, because I lost a house in that market, right? I had bought something at $610,000 and short sold it for $250,000. So I've been through every storm that exists with this real estate market and mortgage market. Coming out of all of that, just always kept my mortgage license. I'm number 65 in the state.
That's impressive.
That's cool.
I think there's 65,000 licenses that have been issued.
Wow.
It's not because I was like a pioneer. It was just one of the first people in line.
Right.
Yeah.
And it sounds cool.
Yeah.
Sounds great, right? So anyways, worked in the title company for a while, still had my license with mortgage companies. And then a couple things happened in life where I was like, you know what, it's time for me to become my own boss again. And so I just put my focus on it. And about a year and a half ago, the application was approved by the mortgage lending division, and Fifth Bridge became a company that could loan money as a licensed mortgage lender in the state of Nevada.
Okay, interesting. Well, thanks for sharing. It's always good to hear how people got to where they are now, and particularly going through crisis or some sort of financial difficulty. That's where I think you really learn.
Yeah.
Anybody who's been investing in real estate the last 10 years, I'm sure they're learning a lot of stuff, but there's a lot of stuff that's happened and it's going to happen that they don't have experience in yet. And so it's good to be working with somebody who's been through those difficult times.
So if last year and a half, Fifth Bridge funding, what do you guys focus in? What are you typically looking for?
Well, I mean, we focus on what the business is right now, and the business is still fix and flip.
Okay.
So I would say about 50% of my business is that. I market to cash buyers.
Okay.
The reason why I do that is because, one, they have all the money and they usually have the experience. My pitch to them is, why would you spend all your money on one deal when you could possibly be doing 2 or 3? All right.
Leverage, yeah.
I come in as their private money lender. I'm asking for about 30% down on a purchase price. That is negotiable. Also, the rate is negotiable based on down payment, but that's who I'm marketing to. By way of doing that and being in this industry as long as I've been, I still have realtors that are coming to me with different types of deals. I also have, some vacant land guys that are like, hey, we're going to develop this in a couple years, but we still need to hold it. We want to pull some cash out of it. So I get a mix of business. The craziest deal that I got into, which, I love it, is I got into a hemp farm. I had a real estate agent that's down here in town that had a partner that is up in Winnemucca, Nevada. I have 2 daughters that go to college at Reno. So I have a way of going and visiting this property and visiting daughters at the same time.
2 for 1.
But so this farmer, had 360 acres, owned all the water rights, owned all the land, was currently growing alfalfa and had been for about 15 years, and said, I want to get into hemp, but there's no bank that's going to loan me money.
Yeah.
There's really not a lot of private investors that know anything about Winnemucca or want to come out here. And I have plenty of experience with water right deeds of trust and securing certificates and loaning against real estate, or at least vacant land. So I took on this project, and I am a lender based on the land value and the water rights value. And what the farmer is doing with the property is he's growing 120 acres of hemp and 120 acres of alfalfa. Now, let's talk about success stories. It snowed in Reno in September. It snowed,
I remember,
a month and a half before it was supposed to snow. It affected his crop.
Oh, man.
Right? I mean, he's got a grow season that has to go into, it's called Croptober, which means your grow season goes into October. That's when your plants and your bud and all that flower grows to a premium level. He had to harvest early because of that snow. We're okay. He's okay.
Yeah.
It's not going to be a bad thing, but it's one of those things where, we are secured on the land, we are secured on the water rights, but in essence, we are partners with this farmer. So he came to us at the end of this season, said to me, we're going to need another year. We made a lot of money, but we didn't make enough money to pay you back and to still prepare for next year, which is the seedlings. It's, getting everything ready to plant again. And I went to my investors and I said, look at our track record already. Look at what he's done. I went up there twice to visit the property. And I do that at no cost to the borrower, to the investors. This is just part of my service. And I'm like, we're okay. We are absolutely okay. And the farmer's okay. He's just not going to pay us back $420,000. And they were like, it makes sense.
You mean he's not going to pay us back right now?
Correct.
Okay.
Yeah. So the loan is a 1-year loan. I'm a bridge lender, right? So I do a loan for 1 year. Where are we at in a year? The note is due. Do you want to extend, or are you going to pay us off? And he said, well in advance, I'm going to need another year. So we just put together the extension.
Okay. Now, I would think most of our listeners what I think they'd be interested in, I think there's going to be two sides. One is the people who are fix and flipping, right? But then there's also, we have a lot of listeners who are sitting on cash, and maybe they don't want to flip or get into that piece of the real estate, but they would love to be the bank, right? So how about, what were you going to say something?
Well, I was going to say that most of my investors are previous flippers, real estate agents, people who understand the market, but don't want to be the flipper anymore and would rather be the lender. And so that's when they make their interest rate.
Perfect. So can you share like a case, or I don't know what you call it. What do you call it? A case?
A deal?
Or a deal?
A deal.
A deal. Maybe explain, kind of go through some big pictures of a fix or flip or some sort of scenario.
Yeah. So we're closing one today. So it's always best to do the one that's freshest. We're closing $375,000 loan.
Mm-hmm.
The buyers are paying $485,000. Okay, so they're putting down about $95,000. Give or take. They're unique. They are Japanese investors. They were in town for TPC, the tournament.
Mm-hmm.
And while they were out there walking the golf course, there was a sign on one of the houses at the golf course that was on one of the fairways. And they called up their realtor and said, we want to own a house on a golf course. We want, because we have a certain number of friends and family members that would love to sit on a golf course property, drink a beer, and watch people play golf. So out of country buyers, I'm able to loan to them. I'm not doing it based on credit. I'm doing it based on value and what they're putting down. I called up a couple of my real estate investors that live up in the northwest part of town, that know the area. I said, what do you think? Do you want to go forward on this one? This is what we're looking at. And like I said, today we're funding this. It's going to be $340,000. And it's a beautiful house. It sits on the golf course. They're going to get a rate of return of 12%. So it's not 12% monthly, it's 12% annual, so 1% a month. These Japanese investors, their plan is to go in with about another $50,000. Unfortunately, the houses in this town get dated quick. It's not just the travertine floor that you put in like 5-7 years ago.
Yeah.
It's also your countertops are no longer cool, your cabinets are no longer cool. So people go and they got to update these houses. And so now this is a house that has a chance to just, with this fabulous location, they're going to get updated. And then they're going to turn around and be able to refinance with their bank's money. They actually have a bank relationship out of Japan. But this Japan lender was like, we can't put it together this fast. So yeah, I hope this loan lasts about 3 to 4 months. We always have a 3-month interest guarantee. We spend a certain amount of time getting our investors into deals. So we write it right into our note that says, you're going to have to pay on this at least 3 months. If you sell in 2 months or refinance in 2 months, there's still going to be 1 more month due because the investors, like I said, spend a certain amount of time getting into deals.
Okay, so on the investor's point of view, they're getting 12%, which is a pretty good interest rate.
Their protection is the deed of trust. So what I do is we draw a deed of trust, note, deed of trust, all of our other supporting loan documents, but the deed of trust has an Exhibit B, and the Exhibit B it actually lists the investor's entity or how they want to take title. It's called vesting. It shows their percentage of ownership or percentage of vesting, and it's recorded on that deed of trust so that if the borrower failed to perform, we could start a foreclosure on that deed of trust that is insured in first trust deed position. We have an ALTA policy of loan insurance. It's an ALTA loan policy of title insurance. We also have insurance on the property that the borrower has put in place, and we would start a foreclosure.
Okay.
That's their protection.
Okay, and they're going to be on the deed, so
of trust.
Right?
Deed of trust.
So it's not you or it's not some third party. It's going to be the actual investor.
My company is required to show our unique identifier on the deed of trust. So my actual license number is on the note and deed of trust. But the actual investor that is, vested on Exhibit B actually shows on that deed of trust and is recorded.
Okay, perfect.
I say this, and I said it this morning. I always assume, and this is horrible to say, that I can walk out the door and die.
Mhm.
So loan documents are always kept at a loan servicing agent's place of location. So all the original documents are there. All money flows directly to the title company. And then when payments come in, they flow directly to the loan servicing company. And then finally, when payoffs happen, the loan servicing company issues a demand to the title company. When that payoff happens, the loan servicing company takes that money and directs it back directly to the borrower. So no money, no documents. I always have a complete file in my office, but none of that goes for me. I don't have an investor trust account. I don't have a loan servicing trust account.
And the reason you don't have those trust accounts is because you never touch the money. The money goes directly into escrow.
That is correct.
Right. So the title company holds it.
That is correct.
Okay, perfect. Okay, great.
Yeah, it's an extra layer of protection so that, again, if anything were ever to happen to me, the investor's protected, the borrower's protected. Obviously I want to be the conduit. I want people to talk through me. But if for some reason anything ever did happen to me, they still have methods. It's not like they're lost in limbo for like 2 months trying to figure things out.
With these investors, are you trying to do you pool investors, or do you try to get one investor a deal? Or
in a perfect world, an investor will always take the deal by themselves, or they will take the deal with another investor that they're familiar with. So you two, if I had a deal and you guys wanted to fund it, I'd put you guys together because I figure you have working knowledge of how to work together. But I don't put people from questionable. It's wrong to assume, but I won't put people together that don't know each other or have never worked together, or at least I don't, I have to qualify every one of my investors. It is a statute. We go through and we make sure that they have certain ability, that this is not their complete life savings. Can't do that. But at the end of the day, I also want to know that so 2008, it was called herding cats. We foreclosed on a property and you had 30,000 opinions on what should be done with that property. And at the end of the day, you have to have a common direction. It's foreclose, or is it work with the borrower? What do we do? Do we sell it? Do we keep it? Do we manage it? All of it has to be common. Otherwise,
Tell us a little bit about that foreclosure process. You mentioned it just a couple of times.
So state of Nevada.
Yeah.
There's a statute that a trustee has to follow. Give or take, it's 120 days. So if a borrower goes default, first they're given a warning. You call them up, especially me. I know my borrower. So I call them up. I go, hey, what's going on? Can I visit with you? Tell me what's going on so I can share this with the investors. A certain amount of time is going to go by where the investors are like, enough's enough. 30 days, 45 days. They get to make the call. It's their money. We start a foreclosure process. We have to hire a trustee or Nevada Trust Deed Services. Mm-hmm. And what they do is they begin a process, which is a legal process that follows a certain set of procedures. The first 35-day window, and by the way, I didn't write the book on this, so I can't tell you that this is exact knowledge, but it's close. The first 35 days is the borrower's time to redeem the note and deed of trust. So they are in default. A certain late charge is accrued, a certain interest rate might have accelerated, but the borrower could come in and say, hey, I was out of town, something bad happened with the family, but here's the money to cure the loan, and I want to resume making payments. Okay. After that 35-day period, then we have another whole window, which it's the time for the borrower to refinance the property or sell the property. Those are their options. Then we get to the final 35-day window where it's notice of publication. So then it goes out publicly that, it goes to Nevada Legal News. It can go to the library. It can go into the Review Journal. And it basically says that a deed of trust that was recorded on such and such a date is now being foreclosed upon at a public place, which is usually Nevada Legal News. And here's the date and time and the amount that they're foreclosing. So now we can go to the next step. I apologize. There's a lot of information.
Oh, it's good.
So we get to the foreclosure sale, and the investors have an opening bid amount. So let's just say that they loaned $100,000, but today they're owed $112,000, $115,000 because there's back due interest, back due late charges. Maybe they had to, well, they did have to pay the trustee to do their job.
Some costs.
Yeah.
Okay.
All of that can be added to the balance, all right, so that they can be made whole. So at the beginning of the sale, the trustee says, here's what we're doing. We're starting at $112,000 because that's what you're owed. So the bidding starts, and it can go up in increments. You know, as long as it goes over $1 over what the investors are owed, the investors are made whole. That extra dollar, and I know this is a little confusing, but anything over the $112,000, we're using that number, goes back to the borrower because it's a real sale, right? So if it goes $45,000 over, the borrower gets $45,000, the investors get made whole, right? They got all their money back. Everything's done. Couple things can happen from there. Let's say no one bids.
Okay. Yeah.
No one bids. So at $112,000, the gavel drops and the investors get the property back. It's now theirs. Okay.
So now they own it.
They own that property.
So now if they were to sell it for $45 more, they keep it.
Yes. So the day that they own it, they can list it for whatever they want. You know, the $45,000 over that, they could list it for the $112,000 just to get out of it. They could agree together, let's keep it for a couple years and rent it out. Let's get some income coming off of it. It's very rare in private money or hard money that we get property back, unless it's 2008, where the values just went through the bottom. We had a foreclosure sale last week.
Tell us about that.
You want to? Okay. All right. So this loan, I didn't make it, but I serviced it because the mortgage company went out of business. So
why did you feel obligated to service this?
One of my good friends was an investor on that loan.
Okay.
Okay. Two, there was 5 investors, and for the most part, they didn't know each other. Right. So it was a group fund. They didn't know each other, and I knew all of them. So I didn't know them well, but I knew who they were. So I knew how to communicate with them. And like I said, it was, for a long time, it was a good loan. The loan was originated in 2002. Okay. Some bad things happen. Someone got shot in a parking lot.
That's a bad thing.
That's a bad thing.
Yeah.
The county commissioners said, we're going to strip your license.
That's a bad thing.
Until you can prove that you are able to be safe and secure for your patrons. So we gave them, or the private lenders gave them, 8 months to get things figured out. You know, and over all those years, what is that, 17, 18 years? You know, these borrowers would pay 10 times that year, not 12. So over time, this loan just kept on getting further and further past due. But so when we foreclosed just a couple days ago, it was enough's enough. These investors have gotten so old. 2 of them have passed away.
Oh, wow.
So now it's the estates. It's their attorneys that represent the estates. It's the family members. And then there's a couple of investors that are just very old. So it was like, let's just be done with this. It was a note for $410,000 that was made back in 2002. They must have got 15, 16 years worth of interest at 12%.
Wow.
So the investors as a group decided, let's start bidding at less than what is owed, because we just want to sell this thing. We want it to be done. So they started bidding, or they opened the sale at $350,000. Someone bid and they were done. So on the note, they lost $60,000.
Okay.
According to their fractional ownership.
Yep.
So like if I had 12% or 25%, I would have lost that percentage of the 60. But I also got, did you do it?
Well, of course I was doing a little bit of math, but I was just doing, if we did 410, and you had mentioned the rate was maybe between 12 and 10%. So I just did 10%. That's $41,000 of interest a year.
Yes.
Okay. And let's do it for 15, even though it's been a little longer.
Yeah.
Right. Okay. So that's $615,000 of interest.
Correct.
When they loaned out 410.
Yes.
So they've got all their money back plus 200 grand plus
they're getting their principal back, almost all of it. They got $350,000 back. And they didn't have to own the property. Now, whoever the investor is that bid $1 over what was owed to us, I did talk to that investor through their agent, and they said, we have already talked to the liquor board. We've already talked to gaming control board. We've already talked to the people that are in the property. I don't want to talk about who they are.
Yeah.
We've talked to the people that are in the property, so we might actually figure out a way to make this whole thing work. The investors that I represented at that foreclosure sale couldn't do that.
Yeah.
Right.
Because they're just so,
That wasn't their expertise.
yeah, it's not their thing.
Perfect.
Now, sometimes around hard money lending, I wrote down a couple misconceptions that I've kind of come across over the years, and I hope not to offend you.
None.
Right, Sinko? But
We'll
one of them is that a bad connotation is that hard money is that they charge points, right? High interest rate, almost kind of predatory. I hate to use that word with you, but that's kind of how somehow it's explained or perceived. Can you explain to us? I see it totally different, right? Is on some of these real estate deals, I see you as being a partner on these deals, and that's kind of what you described to us. Can you maybe explain on that point of view a little bit?
It can be predatory if you are loaning money on someone's primary residence.
Okay.
Those are called high cost mortgage loans. And the idea behind that too is this is a place where a family lives or a person lives. So I don't think there's any place, or at least in my business, there's no place for loaning against a primary residence. On the second side of this, there are points that are involved. It's my business, right? I have to keep my doors open. I have to keep my overhead going. Technically, we could charge whatever we wanted in points, but the market tells us what we can
Dictates
charge.
it,
Yeah. So in my practice, and it's published, I'm not afraid to say it, I only charge 2 points for a 6-month loan. That is a flipper, right? Hey, flipper, come on in, show me what you can do. If you can do it in less than 6 months, you've only paid 2 points. Let's go back. You got a point. A point is based on the loan amount. So if I'm loaning $100,000, then you're going to pay my company 2 points or $2,000 to loan you that $100,000. You talked about, what did you call it?
Predatory?
Not only predatory, but the idea of, you know,
I see it as more of a partnership, right? Is people trying, right? It's hey, I want to buy this property and I can't get traditional financing, and so there you are, come in to help me out. And I don't think a lot of people see it that way.
Well, and I'd like to say I'm less than a partner.
Okay.
Because a partner will say, well, we're in this together.
Yeah.
Right. And not only do I want you to pay me some money for the money, I also want a percentage of your profit. I'm a partner, right? Yeah. We're in this together. In this case, I'm your lender. You know, I'm willing to take a certain amount of risk, but you're going to also put up a lot of money. And when I say a lot of money, 30% of the purchase price.
Okay.
You know, you've got skin in the game. I've got skin in the game. I'm relying on your expertise, or I'm relying on you to go out there and hire the proper people to fix up the property and get it to a place where you can sell it. I don't want to go out there and manage it with you. I go up to Winnemucca because I wanted to, right? This is something that I just, to be able to say that you're a part of something like that, and to see these plants growing out of the ground and going, you know, it's not THC based, it's CBD based. So I know that, you know, some way there's a medicinal purpose to it, you know, and I can go home to Trumansburg, New York and go, guess what I've got, you know? Yeah. So yeah, I don't consider me a partner. I'm not free. Yeah. I'm not cheap. There is a certain cost that's always associated with doing business. The alternative is pay cash out of your own pocket and then spend, you know, your whatever savings that you have to improve the property, or bring in a partner. And when you bring in a partner, they're going to want a percentage of profit.
Sure. Deal
with going to a bank and jumping through every one of their hoops that they have, and that they move like a turtle. Go to a conventional lender and deal with an underwriter who keeps on coming back with other conditions, or come to a private money lender, pay a little bit more, and have your deal closed in 5 days. That's my pitch.
Love it. How about another misconception? The other one I wrote down was, I think you kind of touched on this earlier, but only broke people use hard money, right? Is they can't get it from somewhere else. Is what I've actually seen, is you kind of touched on, is I see a lot of really wealthy people that are using hard money, and a lot of fix and flippers that do have cash on the side that are using you and that ability to leverage. Can you touch on that a little bit?
Yeah, I mean, I would never call them broke. I think that I'd rather call them inexperienced.
Okay.
And with that being said, and maybe some of my borrowers
Pretty
will
good.
be offended by that,
Mhm.
I've lost a lot of borrowers, and I've lost them because they've done really well. So I've made them successful. They've been able to do 4, 5, 6 flips, and now they have the cash, and they don't need to pay my points and my interest rate. But so I am that bridge type lender that gets you into a deal, or at least helps you get into a deal and helps you be successful. I'm not going to do a deal if you're not going to be successful, because I'm not in it to foreclose. I'm not in it to take a property back. I don't want to see it not work out for you, and also have my investors like worried at night, about a deal that's not working out. So, inexperience is the best way, I think.
Okay. And then you're taking on some risk in this whole deal, right? Right.
I mean, reputation is everything.
Yeah, sure.
I mean, being out here since, as long as I've been out here, I'm sure I have some people that aren't too happy with me, for various reasons.
Anthony's not happy with me. So. You're good.
But I have friendships that go back decades from living in this town. And reputation is everything. So I think the most risk that I take on is my reputation. If it turns out to be a bad deal, my investor's not going to come back.
Sure.
So, it is all in how you handle people and work with people. That's the risk I see.
Yeah, absolutely.
Otherwise, I pass on the deal.
How often do you pass? I mean, out of 100 deals that come to you, how many are you moving on? How many are you driving out and checking out?
I literally have looked at, in the last year, I've looked at probably about 150 deals.
Okay.
I've assigned 47 loan numbers.
Okay.
That means I liked the deal enough. I gave it a loan number and proceeded with the application. I've only closed 37 or 38 of that 47. So certain deals fall out because property sells. The borrower couldn't put the down payment together. Something might have happened with that. Got the money cheaper elsewhere. I've had that happen too. Where I've had a borrower that's like, I am shopping you. Yeah. And I'm like, I'm okay with that. At least you told me. So I'm not, you're not going to be my priority either. Mm-hmm. Here's my terms. If you can do it, great. If not, or if you find it better, good for you.
I'm glad you mentioned that. How much competition do you have in this space?
I wish I knew them all.
Okay.
I mean, I definitely know that there's 5 or 6 licensed companies that are doing exactly what I do. There's a few of those that are willing to take on a little bit more risk. Like they will do owner-occupied property. I won't. Just not interested in all the extra hurdles that come with it. And I don't want to put borrowers or investors through that type of process. There are investors that are out there that are doing deals without a license.
I was just going to bring that up. I noticed that in the intro, right on your website, it says licensed Nevada private mortgage or private money mortgage broker. Yeah. Can you tell us how important that is?
Well, most importantly, to do business in the state of Nevada, you have to be licensed and you have to be brick and mortar, which means that you have to have a physical location that the borrower or the investor can visit. Okay. There are investors that are running out of their house or out of their car. I don't know how to describe it. How important it is. I mean, there's a lot of strategic steps that you have to go through to get a broker license. You have to be a licensed loan officer and I don't know the statute for sure, but I think it's like 5 years.
Okay. You
have to be continually licensed, continually employed by another brokerage in order to apply for that license. You have to be financially solvent. You have to have a good credit background. I mean, even though I don't look at credit, they need to know that I have good credit.
Sure. So you're not at risk to maybe do something unethical, that you got your finances taken care of.
Correct. Okay. And we have to continue to prove that. We go through a financial audit every year. We also have to submit quarterly to the state and also to national. So there are these requirements. We hold ourselves, or at least I hold myself, to a really high standard. And it's because we're accountable. We're accountable not only to our borrowers, but we're accountable to our investors. There are investors that are out there. There's misnomers that are out there that people or investors are saying, well, I can loan my money 5 times a year without a problem. There is actually something in the statute inside of 645B that says that. But it also says that if you are doing that, then you need to apply for an exemption with the state of Nevada. The mortgage lending division, the commissioner wants an application from you. They want to know why you're loaning your money 3 times, 4 times, 5 times a year, and why you think that you shouldn't have to have a license to do it. I will say that seller carryback, that is a legal activity, It's not illegal. Where if I sold my property and, for some reason I needed or wanted more, or the person that was trying to buy it didn't qualify, I could do seller carryback and not have to have a license. There's other, groups, organizations that can work without a license.
So with the seller carryback, so you're selling it, but you're carrying some of the loan.
Yes.
Right. Okay.
Yeah.
Okay.
I mean, 5 years ago, it was even more common, right? There was buyers that were getting back into the market. They were like, I lost a house in foreclosure. I want to own a house again, but I'm never going to get qualified from a traditional lender. So they talk to the seller and they say, hey, will you accept a large down payment, right? Because that makes the seller comfortable.
Yep.
And you be the bank. And the seller's like, yeah, I'll do it at a competitive rate. Could be 6%, could be, something like that. That's what it was back then. And then they carried the paper for 3 or 4 years for you to get you back on your feet, own the house, pay the taxes, pay the insurance, and then refinance them.
Okay.
You said there's 5 or 6 others, I think you mentioned, as far as hard money lenders
That I know of, yeah.
that you're aware of. Is if somebody is looking for hard money, what is some of the due diligence that they might do, or some potential red flags that may pop up when they're kind of researching one of you guys?
Good question, Cam.
That's a great question.
You're welcome. Yeah.
I think, the internet's an amazing thing, right? Okay. Get on the internet, Google every one of those hard money lenders that are here in town, look at their website, look at what they're saying that they did, what kind of deals that they post, or are they looking for investors? I think the second thing you do is you call them. Get on the phone with one of them, see if they answer the phone or if they return the phone call, right?
Right.
And then find out, over the phone, what kind of deals are they selling? What kind of deals are they looking at? I think the third thing you do is you go into the office, you go meet the staff, you get to know a little bit about their process. And then the fourth, if you really are on the fence, ask to talk to a couple of their investors.
Okay.
Say, do you have an investor list that, are willing to talk to a new investor and find out if they're willing to share their experiences? Yeah. So I think that's probably the best way.
Steve, we have a lot of clients. A lot of them are in Nevada, and to be honest, most of them are not. What resources would you have? So if they're looking for a hard money lender, is it just simple Googling hard money lending, or is there an organization or some resource for them to find hard money lenders in their area?
So there is an organization, American Association of Private Money Lenders. Okay. You can definitely reach out to so if we're talking about a borrower, you could reach out to that organization and say, do you have anyone within your organization that is in the state of Texas or Utah? And usually people that are members of organizations hold themselves to a higher standard. Again, yes, you can definitely Google and just say hard money lender, Nevada, hard money lender. And if someone like myself has put together a fairly good web page, I'm going to get some hits. After that, I think it's your realtor. If you're trying to buy a property in another state and you don't know anything about that state or who's lending in that state, your realtor should probably have a good idea of who's out there, who's working in that community. I send out 14,000, I don't personally do it, but 14,000 emails go out once a week to all the realtors that are licensed in Southern Nevada. My license is the whole state of Nevada, but I focus on Southern Nevada. So they at least get an email from me with my loan program. And if a borrower or a buyer were to call them, then they could say, oh yeah, I've heard about this guy, or I've seen an email from this guy, and they can forward it along and they can give me a call.
Okay. So we do have a lot of flippers that are listeners, and some of them they're fairly new to the game. Any words of advice from a private money lender that you've seen them, any words of wisdom for somebody just getting into flipping?
I think that saying about if it's too good to be true, then it usually is. If you're coming to a legitimate lender like myself, it's not going to always be the way that you want it. And these these new flippers, these new borrowers will call me up, and they've been on YouTube or whatever, and they're like, well, I want you to loan off the ARV, after repair value.
Yeah.
That's a future value. You know, that's something like, after I've done my work, it's going to comp for $300,000. I'm like, well, what's the purchase contract? Well, I got a great deal, $150,000. I'm like, well, then that's the value. No, you should loan off the ARV. And I'm like, I understand that you think I should, but I'm not going to, because again, as much as I could get hit by a bus tomorrow, you could too. And then we're stuck loaning over and above the value of the property, which is what was paid for. You know, that being said, I think that, listen, that's another thing that, you know, these new flippers, these new investors that want to get into the business need to do is listen. And it's not only listen to your mentors, the guys that you're working with that have done 20 houses in the last 8 months. You know, it's also listen to the people that are out there loaning the money, the investors. It's listening to your inspector. It's listening to the other people that are in the industry that at the moment don't have a vested interest in you, and they're going to give you good advice. They really are.
And what I would add is, if you're taking a deal to a hard money lender and they're not willing to loan against it, that's something, maybe you need to listen to that. And maybe this deal is not as good as you first thought.
It's a strong possibility that we see something that you don't see, or I've already seen the deal. I have that happen a lot, where a deal has been shopped, you know, has gone around, and I've already seen it 1 or 2 times. Or I'll have an investor call me up and go, hey, I just heard about this deal. What do you think? And I'm like, heard about it last week. You know, you might want to stay away from that one. And here's what I saw.
Okay.
Awesome. I was just going to say, where can somebody find you? Right? What's the best way to contact you if we've got somebody that's looking for some hard money or just has some questions? Yeah. Where can they go? So my website is fifthbridgefunding.com. It's the number 5. Okay. thbridgefunding.com. My cell phone number is 702-281-2304. My email address is fifthbridgefunding@gmail.com. My office location is over at Maryland Parkway and Pebble. Okay. So I'm on the internet. I'm in my office. I don't say you have to make an appointment, but you know, I'm the only guy. So, you know, there's a good chance that I either have 2 or 3 things going on at the moment, or I'm out here doing a podcast. So it might be hard to get a hold of at times, but as soon as I hear from you, we'll make an appointment. I make it happen. Perfect. We'll be sure to share all that information in our show notes. Anthony, you got one thing?
I had a question, because you mentioned a couple times where you've given us our history where you had worked in restaurants in LA and then in Vegas, but then a couple times you'd mentioned that you had that entrepreneurial spirit and you wanted your own business. Can you maybe, and we have a lot of listeners who are kind of on that edge. I mean, most people start out at an employee and never even imagined starting their own business, but eventually something happens to us and we decide to make the move. Can you share kind of your journey from, you know, that's the so-called security of having a paycheck to working for yourself?
So my first business, I was 8, might have even been a little bit younger. Okay. And I was swimming at the swimming pool, and I would just notice that kids would get out for snacks or run over to their moms for snacks. And I would make popsicles at home. That was my thing. I grew up in Saudi Arabia. That's another whole story.
I didn't know that.
Wow, that's a total right turn.
Yeah, that came out of left field there. All right.
So yeah, I grew up in Saudi Arabia. I'm what's called an Aramco brat. That's an oil company that's overseas. And so I would watch these kids run over to their moms and, you know, get a snack. Well, I was making popsicles at home, and it was Kool-Aid put in a Dixie cup, and I would kick it up with extra sugar.
Nice.
So I would start taking these to the pool in my little red wagon with an ice chest. And these kids, I'd be swimming, I'd look up, and there'd be like 4 or 5 kids standing next to my cooler. So I get out, I go sell like 4 or 5 popsicles, jump back in the pool, keep swimming. And I was making money.
At 8 years old, I love it.
Money. I was buying my own candy bars, my own milk. Like that was my thing, man. Candy bar and milk right after swimming, just make my stomach float. But yeah, and then I bought my own bicycle. So it was like, I did that, you know, and it wasn't like a business I did for years. I just did it, and and I never forgot it. Coming over here, going to college, working in restaurants, working for other people, I loved a paycheck. I was never about bonuses. I never, I always was more concerned about doing a good job, making the company money.
Mm-hmm.
But what I started to realize is that no one's going to pay me what I'm worth.
Mm.
And, there was a time there where I became a real estate agent. I'm still a licensed realtor. And the whole reason was I could provide a service that no one else, or else I thought no one else could provide, to my friends and my family members. And making that commission and having that write-off and, being able to use your business to push yourself forward and grow, I was like, this is the only way.
Yeah.
Finally, with hard money. I mean, I worked for one of the big ones. I tried working with 5 or 6 other mortgage companies over the years and saying, let's bring some hard money in here. And they didn't get it. They didn't want that regulation under their roof. There was only one company that was a little bit interested, but at the end of the day, the costs that I would have to pass along to the borrowers didn't make sense to me. So it was just more of being patient. And I mean, if you could see my notes in my phone, because I leave myself notes all the time. I'm like, this is my vision. This is what I want to do. This is why I want to do it. This is another reason why I should be doing it. And I can go back and look at that stuff from 2014, 2015, and it was just being patient till the moment that I could apply for the license.
Awesome.
And do what I'm good at.
Awesome. Thanks for sharing.
Yeah. Thanks for having me, guys.
Absolutely.
This is fun.
This has been great.
Good.
Yeah.
There were definitely some nuggets in here that I think our listeners are going to be able to take and to apply to their businesses and growing wealth and passive income outside of Wall Street. So thanks for coming.
Thanks for listening, and be sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.